if wealth tech has to sustain, there are two things which has to work very well. Everybody believes that they know everything about FD, but they don't. But we see ourselves like a full wealth tech platform which will not be limited to fixed income. We will get into mutual funds, we will get into equity. Multiple founders like Harsha, Sachin, Shrikant from Fractal is that never think very short term. In the last 4 or 5 years, people who got into YouTube, the idea was not to create wealth for their audience. The idea was to get more and more subscribers to the channel. Thinking long term, we realize that this is the customer base which believes in trust. Because we may be the only fintech right now who still has full-time calling support to our customers, because we believe that that's the best way to build trust. We have spent almost 4,70,000 minutes talking to our customers in the last 1.5 years. So I've seen the value of money at that point in time. And that's one thing that stayed with me a lot, that money won't solve all your problem, but money will solve your money problem.
How easy or tough has fundraising been for you as a founder? And what advice would you give to founders when they seek out their first VC partners? Saurabh, good morning. Thank you so much for joining us on That One Idea, which is now in season 4. It's a podcast series that for us helps us, I would say, unravel the backstories to starting up and really, I would say, deglamorizing entrepreneurship. So thank you very much and welcome to That One Idea.
Thanks, Anjali. I think I'm super excited for this. I've seen some of the last episodes. I think a lot of great and detailed insights. So I'm very excited for this.
Awesome. So I would like to start with your own personal backstory, I would say, and would love to know who or what influenced you the most growing up.
I'm from a tier 2 city, Aurangabad in Maharashtra, the only child. Dad is very entrepreneurial, but somehow never worked out for him. He tried multiple businesses. So I've seen him doing that, and with every time when he was doing it, equally excited about that. Okay, maybe this could be very big. That wasn't working. So my mom was also working. She ran a beauty parlor at that point in time. So I've seen the value of money at that point in time. And that's one thing that stayed with me a lot, that money won't solve all your problem, but money will solve your money problem. So that is very critical for me, and that has stayed so far. For the last 5-10 years, the time has changed a little. So, but doing something, making it big, there's only one chance that you have, is something that has always stayed with me. So when things were working very well with my first job, when I was in Geneva, I wanted to come back to India. When things were working very good at Swiggy, I wanted to try something new. And when things were working great at Navi, I said, I want to start something again. So I think that's always doing something is very important, not sit back, relax. Kind of attitude has come mostly from what I've seen from my childhood. Always the kid who is never so important to anybody. In class, nobody knows, because I'm not the top 3, not the bottom 3, is always in somewhere in the middle. In sports is always like that. So there's always that hunger and drive to get noticed. So I think that these are some of the things that has played a very critical role in what I'm doing.
And you already took us through some of your early journeys as a working professional. Just keen to understand maybe 1 or 2 takeaways from each of those 2-3 stints, including your first 2 startups in agri and edtech. And today, as you reflect, what would you say are some of like your top learnings or reflections on those journeys that have helped you the most in your role as founder of Stable Money?
See, we have done our first venture when we were in college. And that's with Harish, who's my co-founder now at Stable Money. And at that point in time, both of our goals was to make money. And we were doing something on the edtech. Now, cut to 10 years later, we realized that if we would have continued that could have been a big venture by now, what we have seen in the last 10-15 years, right? So that is one regret that we have. When I was at, and these are small stories, when I was at Fractal, we had our ESOPs. And this is what, 7-8 years back. And then I had to pay my taxes before leaving to get those ESOPs instead, right? Exercised. I didn't do that because 35,000 at that point in time was very valuable for me. I said, but now I realize. Yeah. So I think one thing that I've seen now, seeing multiple founders like Harsha, Sachin, Shrikant from Fractal, is that never think very short term. I think that has been my approach in the initial 4 or 5 years. That I was very, very short term thinking what will happen in the next 6 months to 12 months and maximizing that, doing that local maximize thing. That was the bigger mistake. So this time when we are building whatever is going to be the professional journey, we are looking at what is 5-10 years down the line. And how do you maximize that rather than focusing on what is here and now.
And for Harish and you, given your own long journey as founders together, was it always a very obvious intentional decision to keep like trying your shot at entrepreneurship?
I think last 5-10 years we have been in touch, but we were on our individual professional journeys. When I left Navi, Harish was obviously the first choice. Because I have done startup in the past. I have also seen some of the other companies where your co-founder matters a lot. Somebody who can understand you very closely. So he was the obvious first choice. Obviously, I was doing something on the financial side, and he has experience on that side. So that was my first call, and I still remember I called him on around maybe 11th of August 2022. 17th August, I went to Delhi. We agreed to do it. And August end is when we got the term sheet. Right. So this is fast how it happened, because you don't have to then spend so much time discussing an idea. What we discussed at that point in time, we were not even close to what we are doing right now. Right. So it's just that trust in each other matters a lot in those initial days. So he was the obvious choice for me to do it.
And it's working well. So, and you're also an equal partnership, right? And a lot of times founders ask us for advice on that. What's your take on inter-se shareholding between founding teams? And what would your advice be to founders starting out today?
See, unless there is a very clear, the reason to have a different shareholding, because maybe you started a couple of years ago, before the new founder came in, some other reasons. I don't think there should be any reason why the shareholding should be any different. Or your skin in the game is more high because of some other investments that you have done for the investment. I think it should be equal. The most important thing for us is that though the shareholding is equal, the biggest problem comes is who is the decision maker, right? And for any problem statement for the company or for the team, there has to be one clear answer that for this problem statement, this is one decision maker. As long as that is clear, I don't think shareholding matters a lot, because a lot of time that thread keeps running in the co-founder's head in terms of how is the shareholding and why it is high or low. We never discuss about that, right? We are very clear that this is how it is in future when the liquidation also happened at any point in time. We are very clear that we will liquidate equally. And we'll always maintain that equal shareholding between us. But we are obviously very clear that who is the decision maker when it comes to a specific problem statement. So as long as you follow that, I don't think there is any
need to have a different
shareholding. But I don't know much. Maybe different people have different reasons, and that is what
also want to now segue into what you're currently building at Stable Money. Is it best described as a fixed income platform or a low risk platform?
It's a very interesting story, Anjali, because when we started, we wanted to build something on the corporate bond side, because 2.5 years back, a lot of people who were getting into the corporate bonds business are primary circle people sitting in this room, people seeing outside are mostly people looking for higher returns. So I said, that's a great product to build. When we started, we got into fixed deposit because we realized that's the larger market to capture. And then we were also very clear that we want to build a fixed income investment platform, like how Grow is for mutual fund, how Zerodha is for stocks. We want to build something for the same audience for a fixed income side. But interestingly, because of the choices of the product that we have made, which is fixed deposit, we realize that we are acquiring the customer who is mostly not been acquired by any of these platforms. So these are new to wealth tech. People who have wealth, but they are new to wealth tech. And now our aspiration is not limited to fixed income products. Though for our go-to-market strategy for the next couple of years, we'll always be introducing products which will never show negative returns to the customer because we want to build that trust. But we see ourselves like a full wealth tech platform which will not be limited to fixed income. We will get into mutual funds, we will get into equity at the right point in time, but we want to be everything for the customers. That is our reality chain.
Fair to say it's capital preservation first,
yes,
and very transparent about what the risk profile of the investment will be.
Yeah. Obviously, the question is how the stable money as the name will be relevant in the next 4 or 5 years. But that's a good problem to solve.
That's a good problem to solve, absolutely. Would love to actually debunk certain myths, given you started with fixed deposits. And we all know it's amongst the largest in absolute value. And let me start on the customer side of things. Typically, one would say that only senior citizens allocate their wealth and savings to FDs. And I think the data says about 40 to 47% of current overall fixed deposits is held by seniors.
Right.
But you made an interesting point on how you've actually acquired first time to wealth tech or first time savings happening into FD. Did you expect a lot of younger millennials to come to the platform, or did you go in assuming seniors will be your first port of call?
We had our own doubts, honestly, that and a lot of people also thought that senior citizen will be the largest TG. Obviously, that was not the plan to acquire. And we are also surprised that only 6.5% of my user base is senior citizen. And that too, it's people like us who are telling our parents to go on stable money and book FDs. Right? So it's actually even lesser in terms of number. And my median age is 30. And this was 6 months back, 33. So it's going down, obviously. But I think one thing that we have realized is that what has happened in this last 4 or 5 years is a very big problem. The capital markets were growing. Everybody were becoming influencers. So they were talking about that. And when you are influencers, when you are talking, I think you will talk about the most sexy thing, and that's the capital market. And at any point in time when you are putting money, your money was growing. So people who got into the investment side in the last 4 or 5 years is in a very transient phase, because I believe this is the TG who is also realizing that. And today, as we speak, right, we know how bearish everybody is on the capital market right now for the next 1 2 years. Is you can't put all your eggs in one basket. And I know so many people who are young, who started earning in the last 4 or 5 years, have started putting every money into stocks, mutual fund, F&O, and now realizing that there's so many threads running in their head because it's not easy to manage their investments. So I believe that now the younger generation who will now start earning money, maybe now or 3 4 years down the line, this is the TG who will learn from the mistakes that we have made and be very focused on how the investment should happen. And we have seen in the developed markets in the US as well, like how people do portfolio allocation. That will play a very, very critical role. So I believe my median age will keep falling from 30 to maybe 28, 26 eventually, where anybody who is new to investments will start with stable assets first, build their emergency fund, build their cushion, and then get into riskier assets eventually.
And how do these, I would say, new to savings, and typically a young 25-year-old today who's now able to save, how do they separate the signal from the noise? And in today's age of new media going mainstream, how do they seek out the right advice, and how do they know that this is a trustworthy source for portfolio allocation? And like you rightly said, there are so many YouTubers and influencers out there giving you all sorts of advice. And it's also fair to say that in India, the traditional banking system, where if you look at the traditional banking system, it can be exceptionally intimidating for a young person to walk into a bank and get advice. And it's not even the bank's primary, I would say, role, right? But how do they seek out trustworthy advice?
Yeah. See, I believe that will happen on its own, Anjali, because in the last 4 or 5 years, people who got into YouTube, the idea was not to create wealth for their audience. The idea was to get more and more subscribers to the channel.
Followership. Yeah.
Right? So they will talk about things which will get them, and by that means we'll talk about things which is not very mainstream, right? And that's where they talk about stocks and make money and become a crorepati and all of that, right? Now people are talking about how these influencers were wrong, right? And how you should break the clutter and do things which are safer and everything. So I believe now there is enough content on both the side, right? People have realized that in the history last 4 or 5 years, how many people have lost money, what are the challenges that they have seen, what has worked as well. And I believe the younger audience will now choose whom to follow, what to see. So it will be more on its own discovery, because I've also seen a lot of customers when we talk to, they know that some of these YouTube influencers or some of these other influencers who talk about wealth are not good. So they have discovered on their own that these are not the people that they have to follow. Right. So that's where there is a lot of drive across influencers as well. And we work with so many influencers that they want to do now right by the audience, because in short term, they have realized a lot of gains, but long term, it's hurting. And that's why you will see that with so many people, only few can have that long term journey. So I believe all of that will happen on its own. And people, I don't think there is more and more educations or processes that needs to be set up for these younger audience to do this.
And then moving now to the product itself, right? You've got to innovate a lot, which you have as a platform, in terms of whether it's this whole liquidity myth on FDs that you can't prematurely break an FD, it's too hard to, or the whole, you've come up with an SIP style product where you can save smaller amounts. And also you very transparently disclose inflation adjusted returns, right? Because people assume it's capital preservation, but net of inflation, you're probably making a negative return on your FD. How hard is that journey of educating the consumer on what may seem like basics to you and me as a nuanced investor, but how have you kind of, I would say, whittled it down in, let's say, fixed income 101 for a new investor?
See, I think the biggest challenge for us was that everybody believes that they know everything about FD, but they don't, right? So how do you break that and tell the customer saying that you have been doing FD investment for the last 10, 15, 20 years, but whatever you know is so little about the nuances of fixed deposits. So that's been our challenge. But what has honestly worked for us, Anjali, is that we have always borrowed trust from outside, right? And that's been the best strategy. We have borrowed trust from fixed deposit as a product, because we know that people understand this. This is not a new product that you'll have to do a lot of education. We have borrowed trust from DICGC insurance that is being offered by RBI. So people have a lot of trust. And after the Yes Bank fiasco, there is so much education that has happened on how the DICGC insurance works. We have borrowed trust from the bank names, right? So these are the few things that has helped us get off the ground very quickly. Without people trusting stable money or us have to do a lot of effort. So that has been the beauty of what we have done so far. And again, like what I've told you in the past as well, that thinking long term, we realize that this is the customer base which believes in trust, right? So we have started doing certain things, whether talking about the interest rates, talking openly about what will be the penalty charges if you prematurely withdraw FD, and communicating those things to the bank and see that, okay, these are the challenges. And if we solve those challenges on the fixed deposit, because they are the manufacturers, we can't do anything on our own. So, and we were very lucky to have some of the bank partners who were willing to do that. Like we have a bank partner who is okay to not charge any penalty on the premature withdrawal, right? So when you do that, we have seen customer ask, okay, if there is no penalty, that means for others there is a penalty. So explain me how it works, right? We said that one bank is willing to give instant money as soon as you break the FD, right? That means they say that, oh, for other banks, it doesn't work like that. And why it doesn't work like that? Because you don't have a savings account there. So a lot of these things we have worked with the bank to educate our customers. But I think the biggest thing is because the product is so familiar, people come in, see the higher interest rate, do a small amount. And once they have a skin in the game, once they know that, okay, I have done a fixed deposit with you, I'm willing to sit across the table and talk to you, it gives us a high chance, better surface area to talk to customers, to explain what we can do and build more trust. I think very similar strategy that every bank has followed, right? That every new bank, whether you take IDFC First Bank, whether you take any new bank that has come into the market recently, Bandhan Bank, you always start with a higher savings account rate, right? Because you know that if you offer a 7% savings account rate that nobody gets, customer will come and open a savings account. And when customer opens a savings account, is when you know that the customer is willing to sit across the table and talk to you. That's exactly what we have done. That you start small, you look at the higher interest rate bank, and once you do that, I think we get a lot of time. And that's what I think yesterday as well I've mentioned, that we have spent almost 4,70,000 minutes talking to our customers in the last 1.5 years. Because we may the only fintech right now who still has full-time calling support to our customers, because we believe that that's the best way to build trust. Still a lot of our customer comes from referral. So having that chance to talk to customer is important. But how do you get them to try your product is by borrowing trust from outside. So this is how we have worked. And to be very honest, it looks very intelligent that this has all been thought through. I think a lot of this, we have just been lucky, right place, right time. The rates are good. The banks are willing to work with us. So yeah.
Any interesting insights from all those hours of customer calls?
Yeah.
Especially in terms of some behaviors that have surprised you or were not as per your original premise?
We always thought that people will go for the highest interest rate, right? If there are 10 banks, I don't know any of the bank, I will always go for the highest interest rate because it's sitting as insured. But that's not true. Only 30-35% of my daily bookings go for the highest interest rate. These people have multiple factors to consider. People consider tenure is very important. So you will be surprised that if I give you a 9% FD for a 3-year, and if I give you a 8.5% for 1 year, people will choose 8.5%, right? That's the trust deficit that people have. And I don't know what will happen with the bank for the next 3 years. I don't know what will happen with stable money for the next 3 years. And 8.5 is, in people's head, better for 1 year than a 9%, right? So some of these things is what we have realized. And now we are working with how do you educate what is good for the customers, that if the repo rate is going down tomorrow with RBI's meeting and the FD rates go down, it's good to lock in for the higher interest rate. Now we are figuring out what are the ways to do this, but this is how user behave very differently. We have seen a lot of people come in booking their FDs with smaller amount, breaking their FDs, see the entire cycle, and then go for the larger ticket size. So I think that's very interesting.
Also, Keen, since you mentioned RBI's meeting tomorrow, if we start now moving to macroeconomics, and there are a few, I would say, maybe like 3 broad trends. One is obviously that CASA ratios have been going down in favor of higher term deposits. But of course, the bank is now going to cut rates. CRRs also have dropped. There's a lot of liquidity for banks, and therefore FD rates will drop.
Right.
Again, is the consumer nuanced enough to understand some of these macro factors, and how much of that education and knowledge sharing is on a platform like yours? Yeah.
See, I think the most important thing is what has happened in the past, it doesn't behave exactly same in the future, right?
Yeah.
And that's why otherwise everybody would follow the same trend. Like people have seen in the past that, okay, repo rate will fall, then FD rates will fall, looking for the higher interest rate. But I don't think it will play out exactly the same this time. Because macros have changed, a lot of behavior of the banks have changed. Banks have realized that they need deposit right now. They can't keep changing the rate so much because there will always be the other banks which are offering the higher interest rate. It is more accessible to the customers. It's not only branch banking that becomes so critical, right? So this time what we see is that even if the repo rate falls, I don't think to a very large extent bank will drop their fixed deposit rates significantly as people would expect. That is one. Second is on customer understanding this. I don't think customer understand that so well, right? Because they are not, this is not their day-to-day job, right? To know so many nuances about how bank is thinking, how RBI is thinking. what they hear or what they see is what has happened in the past, what people are telling them either on YouTube or the friends or the family who have seen what things worked in the past. But there are very different, and that's our job to tell the customers, saying that okay, how is the overall macro will play? What would be different this time, even if the repo rate falls, right? So that's something that we want to do right now. But yes, I don't think that with this repo rate fall, at least to the banks that we are talking, I don't think they will change because they are in such a dire need of getting deposits. That's becoming very, very tricky.
Are you seeing behavior change on the bank side, especially in terms of RBI has, of course, made an appeal to keep focused on increasing on deposits and innovating on the deposit side?
Right.
Do you see banks actually play that out? And as you rightly said, with credit growth outpacing deposit growth, fixed deposit for banks is a far cheaper source than other market instruments, right? But are banks also therefore almost now accelerating their own innovation with deposits?
Yeah, no, we have seen that in the last 1.5 years, at least the banks that we are partnering with, that there is so much innovation happening right now. They were never used to allow anybody to create a fixed deposit without a savings account, right? Because that's a deeper partnerships, right? Don't only get a fixed deposit, you also get a CASA. But now banks are okay, and some of the bigger banks are okay to not having savings account because deposit is important. Giving instant liquidity, charging no penalty for the premature withdrawal, having been just more transparent to the customers. I think those are some of the things that banks have been very open. And maybe we see that early trend happening with small finance bank or small commercial banks. But what we see now, talking to some of the big banks as well, I think they have been very open to making these changes, obviously, because the mass is so high that making any small change for the bigger bank will take a lot of time. But you will see that there is a lot of innovation coming in the next 12 to 16 months across these bigger banks as well. Where with some of the banks, we are also innovating a lot of product in terms of what is the innovation that you can do on daily savings, what's the innovation you can do on RD and other things. So banks are very cognizant of the fact that if they want to make sure that the money doesn't flow out from the fixed deposit and CASA to capital markets, they'll have to innovate. It's just that because there is so much legacy of 60, 70 years of running fixed deposit, it takes some time to change that.
And when customers, especially the first time to FD customers come onto the platform, typically what is their objective in making a fixed income saving? Is it more goal based, like there's a goal of say higher education, or they want to get married or buy a house? Is it more in terms of a retirement corpus? Like FIRE is also doing the rounds on social media. Do they think of it as building a retirement corpus? Maybe it's I would say even credit against FD. But typically, do they seek out a goal or an objective, or is it mostly your first set of savings that you're looking for a stable source of capital to set aside?
Yeah. See, I think currently the customers that we are targeting is this 18 crore customers who have been doing FDs in India, right? Just to move those 18 crore customers to the higher interest rate, because you'll be surprised that only 1% of these 18 crore users do 25 crore FDs, right? Of these 25 crore FDs, only 1% of the FDs is earning more than 8%.
Wow.
Right? So the goal is to move these users from the lower yielding FDs to the higher yielding FDs. So we are doing that. So I think currently
it's a large part of the challenge separating out from your savings bank account to again debunk that myth that your FDs can be in a different bank from where your primary salary account or savings account is.
And to be very honest, this is some of my friends as well have the similar logic ki FDs to usi account mein hota jahan bank account. So I think it's very difficult to break that, but that's been the trend. And what you need to do that is you need to have a significant delta, and that significant delta now exists fortunately because banks are giving 5.5%, 6% FDs. You are giving 8.5%, 9% FDs. That 2.5%, 3% delta is enough for people to at least have an attention to do this. So most of the users are the FD users who are coming and booking FDs. And what we have seen, these are two types of goal. Either a very short term, that I have a liquidity. I don't know what to do with this money with. So let me just park it in FD so that there is no loss of money when I have, and I'll take out money whenever I need. And other is, I don't know what to do with this money. I want to keep it for the long term, and I want to just keep reinvesting this money. This is my emergency fund. This is my corpus for doing something like, as you said, gold. These are the broad two reasons why people are doing it. There are few people who are thinking this also as a wealth creation, but not too many.
And what about the credit? I know now we have products on credit cards and loans. Is that picking pace? And do people view it as something that they can leverage against?
So credit card on FD and loan against FD. See, loan against FD is being a very popular product. But mostly going to the branches and doing this. There is still a lot of innovation that you have to do on the loan against FD, but it's picking up now because now people are realizing that even the customers that we see, 90% of our customers have personal loan and FD, and the loan interest rate that they would get on FDs is 3 to 4% lower than what they are paying to the personal loan. It's just because of the convenience of getting that money through your phone in your bank account is that people are paying that 3-4% extra. So if we are able to do that innovation on loan against FD, I think we'll be able to do that as well. So it has not picked up yet because still the process is very cumbersome. But credit card is been picking up a lot, right? Because people don't have credit score. They don't get FD. Second is people have booked large amount of FDs, but their credit card, we have seen 45% of our users don't have credit card. And the other 45%, right, which is total 90%, they have one credit card, but their credit limit is only 50,000 rupees. And when they look at their FD size, they have 1.5 lakh rupees as their FD size. So they would get almost 1.3 lakh worth of credit card limit, but they are getting only 50,000. So these are some of these arbitrage that exist for these customers. I think it's just that working with the bank, making it convenient for the customers and doing this, I'm sure it will pick up. Our credit card is a couple of months down the line, but we are already seeing a lot of inbound interest on taking the credit cards.
Today, of course, you're well beyond fixed deposits and you have multiple other products. You have gold bonds, you have RBI bonds, and even corporate bonds is something you have introduced as well. How do you see the consumer journey evolving as they get more and more familiar with stable money as a platform? You mentioned credit cards as well. So if you could give us a sneak peek into that release.
So I'll tell you our realization about any wealth tech. Right? So if wealth tech has to sustain, there are two things which has to work very well. First is your cost of acquisition should be low. And or your LTVs have to be significantly higher. Now LTV comes from the cross-sell that you will do. CAC piece to some extent we have solved because we have chosen a product which is FD, which is very well known, so you don't have to do a lot of education. So your cost of acquiring the customer is very low. But on LTVs, you will have to do multiple cross-sell. And if you see any fintech or wealth tech for that matter, cross-sell only happens from a low risk to high risk, low return to high return. I keep giving this example of Swiggy that Swiggy can never go from a 30-minute food delivery to a 2-day or a 1-day Amazon delivery. It can only go down one metric, which is time. So it can only go from a 30-minute food delivery to a 10-minute delivery. Similarly, for fintechs and wealth tech, you can only go from a lower return to higher returns. And we have seen multiple examples in the past that anybody who started with a higher return product of a 12-13% and introduces a product with a 7-8%, things that never worked. Because people who are coming to that platform come with that positioning in mind, saying that I want to do a 12-13% return. So if you give me a little more is where I will go naturally and not below. And that's why we have chosen FD as a product, because you are at the bottom of the pyramid. You are the safest product with low returns. And our goal is to now go from FDs to bonds, bonds to gold, gold to REITs, REITs to mutual funds to equity. That's how you capture the entire pyramid of risk, right? And obviously not everybody from FD will transition to the next set of product, but that's how you maximize your LTV. So that's why we have started with FD, and now our next product that we have introduced is bonds. Because we know that the customers who have come for FD are mostly the customers who have been doing fixed deposits in the past. It's very difficult to transition to bonds. But we are very surprised that just in the 4 months of launching bonds, we have a 10% attachment rate. It's people who have done this, right? And 10% in 4 months or 20%, which is our goal for the next couple of months, is a gold standard when it comes to cross-sell. And the major reason that has happened is that people have built trust with fixed deposit as a product, right? Because now they have put so much corpus onto the platform that they feel very trustworthy. It's very easy to go from that product to a new product. And you'll be surprised that 83% of my users who have bought bonds onto our platform, they are buying bond for the first time in their life. And most of them even don't know how it works. It's just that sheer trust on the platform and the product. And people feel that, okay, I'm upgrading myself from a, let's say, 6.5% bank FDs to now 9.5% FD on stable money banks. I'm going from a 9.5 to 11.5, 12% corporate bond. So there is that upgrade feeling that comes to the customer. That's exactly what we want to play out. So our goal right now is to obviously completely launch bonds to our customers. We are introducing gold as a product because now with SGBs shut, right, by RBI, and everybody's talking about digital gold, and we know that digital gold doesn't work because it's not a great product for investment because there is a GST. You are fully taxed on that. The best product when it comes to gold is a mutual fund because it has LTCG on that. The taxes are significantly lower and it has the equal liquidity and flexibility to do daily SIP and everything. So that's the next product that we are launching, which is the gold mutual fund, and then eventually multiple other products. So that's on the wealth side. Now we talk about secured credit card and FDOD. What we also realize is that how do you build a very strong network effect for the customer is when everything when they think about FD is available on stable money. That's our goal. Whether it is any bank, today we have 10 banks and NBFCs on our platform. We are planning to add 10 more banks in the next 6 months onto the platform. And then fixed deposit, then FDOD, credit card, RD, SIP, every auxiliary product around FD has to be there because that builds a very strong network effect. We don't want to leave anything on the table when it comes to fixed deposit or customers to go and do it outside of the platform. So that's something that we are building. Credit card is 1 month down the line. We are already in beta. FDOD will take a couple of more months because we have to do a lot more innovations with the core banking system. So yeah, these are a couple of cases.
Would at scale, would the ideal be when people stop looking at the underlying bank that is that the product, the balance sheet on which the product is sitting on, and the new norm and the new normal, so to speak, in WealthTech is I have a plethora of products across multiple banking partners, where you're actually choosing the best product for yourself, and the bank is merely the, like I said, the balance sheet part.
So that's how we are also seeing it. That customers are looking for the right.
Each of these products could be across several different banks.
And people have different need, and now they are able to pick and choose. You don't have to go to a restaurant and now the entire family sits together and you have to order different cuisine from the same restaurant, right? Now you have Swiggy and Zomato, and that's exactly how it is playing on Wealth. That I don't want fixed deposit of this bank, but the secured credit card has a lot of these benefits. FDOD returns are better or something else. So people can pick and choose what they want to do to some extent even now, but obviously this requires a lot more work along with the banks. I think the only thing that we are very clear when it comes to these products that people should still be aware of all the risks and whom they are partnering with, right? We have been very clear on our platform as well that when you are booking FD with any of the banks, your relationship is with that bank. They are just the mere platform who's doing this. So people should understand those risks as well. So that's our job to do, and that's how we're working with RBI and SEBI as well, to make sure that customer fully understands the risk and they know that this is only the platform. And another thing is, we are not building any wrapper which says that, oh, you book 10 lakh with stable money, we will distribute it to the banks. You should very carefully choose which bank, what is the management, what is the balance sheet, how it works.
Very interesting. And shifting gears a little to fundraising now, and you spoke about how it was really hard in your first 2 startups, and venture capital itself was not a matured ecosystem in your first 2 entrepreneurial stints. How easy or tough has fundraising been for you as a founder? And what advice would you give to founders when they seek out their first VC partners?
Things have changed massively. I think post maybe Ola, Tiny Owl, housing, those days, it was very difficult because there is an information gap, right? If you are not in that particular city, if you don't know certain founders, if you don't know certain VCs, it's very difficult to first reach out and do this because the VC teams were also very small. They had really limited coverage in terms of what is happening. Now, with so much media and everything that exists, I think if somebody has left a job to start a startup, I believe before he thinks about an idea, a lot of VCs reach out, and that's a great place to be in. That's what we have seen now as well, and that's why we are also seeing that so many people are
being chased.
Yes, being chased, and also are willing to do this, take that bet, because I've seen a lot of my friends or juniors are getting into this because they are not worried about the capital. They know that if we are building something good, maybe 3 months, 6 months, 12 months, we'll be able to get some kind of funding that will help us sustain in future. So that's a great place to be in. I think the only caveat or the risk that I see a lot of time, a lot of founders that I talk to are not thinking about the problem statement, are thinking about raising the funds, right? I've spoken to somebody 2 days back and he's thinking that if I pitch like this, or if I solve this problem, will I get a VC funding, right? How do I get to a VC? What should be my pitch? What works? What doesn't work? I believe that's a bad start. I think the good start is what is your TG? What is the problem statement that you are trying to solve? How obsessed you are? Because anybody can see through that, right? And VCs have now seen enough of the founders that they know that, okay, who is just for the funders and who is really solving the problem statement, right? I think that's my only advice, that if you are not obsessed about the problem statement and for you, the real kick is how many $1 million have you raised, I think that is where maybe not in short term, but long term you will struggle because that thing will come out.
Yeah. How would you define value add by investors to a founder? As a founder, what's the best type of value add you would seek from an investment?
I think for me, so far, all my investors have been, I treat them like a co-founder. And I feel that has to be the equation where you sit across the table, and if Anjali is my investor, I should not be worried about telling Anjali that, hey Anjali, I'm not doing this great. It's not working out. These are some of the metrics which are failing. Rather than covering it up, delaying the calls, not like showing some other data to the investors because you want to achieve something else. I think that is the equation that a VC should also have. And a lot of that comes from the investor side, right? Because obviously founder will be on a back foot to communicate that to the investors. Unless you see that approach coming from the VC side, becomes very, very difficult. Just a couple of days back, I have gone to one of my VCs on a coffee meet and I've told her saying that, hey, we have gone from this stage to that stage now, but I don't feel like as a founder, my mindset has changed. I'm still behaving like a seed founder. You need to have that trust with your VCs. And she said that, okay, maybe it's a good starting point that there is a realization, let's work towards it. And now solving for that problem statement. Yeah, if you have that comfort with your VC, it's a great equation. If you don't have that comfort, then you'll have to work it out.
In terms of scaling your own cap table, and you have successfully now scaled your own cap table and got multiple other folks, what has been the hardest part of stakeholder management?
Oh, it's alignment. You have to do alignment across. See, when there is a very clear North Star metric, and you know that not everybody has agreed to this, but you know that this is something your intuition gut data says that has to happen. It's very easy, right? To align on that, to say that, hey, Anjali, that this is something that I want to do. I know you don't agree with this, but I have a very strong conviction on this. I'm sure every VC will follow through that, right? But the problem comes when you have multiple VCs. You don't have a strong point of view on a particular problem statement. And everybody has a point of view on that problem statement. It becomes very tricky. Those are the cases where I'm also learning now that first, either you build a strong point of view or you work it through each and every VC, right? it's sometimes not great to have everybody in the same room and try and find alignment there.
Yeah.
Try and do alignment separately, understand the point of view, and then reach a point where you get all together in the meeting room and do that. So alignment becomes a tricky part because more often than not, you don't know what to do, right? And you seek for advice, and everybody, if you ask for advice, will give you advice.
Yeah.
So, but I think that's the bigger problem when you have multiple VCs or stakeholders.
Awesome. And coming to my last question, and I want to end it on a light note since we've just had a budget and our FM has put in, increase the tax-free limit rather to 12 lakhs and put in a lot more free cash into our hands.
Right.
From an FD perspective, I'm sure you were very happy to see the TDS change as well, both for seniors and non-seniors. So where do you think Indian taxpayers will spend this extra cash that we've all now got in our pockets?
I don't know, like I'm not the expert, but what we are seeing and hearing is more consumption would happen. But I still feel that a lot of that money that is coming in will get into the savings now that is coming, and maybe less on consumption. Some of the numbers that we are crunching is because of this TDS change, there is an additional 50,000 crores that would come just in fixed deposit. Because if you also have to see, right, what is that extra cash? The biggest beneficiary of this is somebody who is less than 12 lakh, right? They will have the most cash. And there the focus is less consumption, more savings, going to the bigger brackets, right? So I believe that is where the most of the savings would happen. And then for somebody who is into 25, 30, 37% tax bracket, whatever incremental get, that will get into consumption. Right, so that's how we see it, but I think the time will tell how the numbers are changing.
Yeah. On that note, I wish Stable Money all the very best. I hope consumers do take your advice and put all that money right back onto the platform. Thank you so much for joining us today, and all the very best as you soar to. You've crossed 2,000 crores AUM now, and I hope that not just doubles and triples but quadruples very soon. But all the best, and thank you so much for joining us.
Thank you so much.
Awesome. Thank you, sir.